Thank you. How many of you were here Friday night? Could I? Oh. In other words, everybody was here Friday night. I can't do the same speech. Whoa, I got problems. This may not be 90 minutes. Maybe more like 9 minutes. Not only that, all the transparencies that I had, I kept in my room, and apparently the maid must trade commodities. Because they're all gone except for a couple that I had in my attaché case. And of course, those were the ones with the good systems in them, too. I don't know. It kind of reminds me, I went in Chicago one time for another one of these symposiums, and as I was going up, the guy was taking my bags on up, and he said, "What are you here for?" And I said, "I'm at a commodity seminar." He said, "Oh, I can tell you all about commodities." Well, yeah, he's carrying my bags. He's going to tell me about commodities. But this maid, wherever she is, can probably tell us a lot about commodities. So we're going to punt a little bit here. I'm going to talk primarily about things I use in trading, and the thing I'll reiterate is a lot about money management, because I think without money management, you might as well walk out of here. You're dead. You really are. And those of you who saw the presentation Friday, I hope that what I do is pound this in your heads even again more, because clearly it's the most important thing that I can teach you, in my opinion. I can show you how to buy lows and sell high and all that kind of stuff, but it isn't going to do you any good without money management. It really will not facilitate any great accumulation of wealth on your part, which is what this should be about. And then I want to talk about the psychology of trading a little bit, because I'm really qualified to do that. I've been beat up a lot in 35 years of trading, and I've made millions, lost millions, the whole deal. And my experience is a lot better to make the millions than it is to lose the millions. I don't know if you can share any emotion with that or not. But when I was younger, I used to have these wild swings up and down. And it was because of, I guess I was kind of a kamikaze cowboy in terms of my approach. I didn't care. It was pedal to the metal all the way. And that caused some wild swings of way up and way down deficits. And I haven't had deficits for years. Of course, I haven't traded for years. No, that's just a joke. But the reason why is because of money management and a psychological understanding. So I'm going to first talk a little bit about that psychological understanding, and then we'll get into systems and then into money management. But the psychological understanding is so critical to the marketplace. And what I'm saying isn't just my experience, but it's a wonderful thing to be Larry Williams, and that I get hundreds and hundreds of phone calls literally every week from commodity traders. And these people I am so impressive to them on the phone. They just can't believe my brilliance, because the conversations go usually like this. "Oh, hi, Mr. Williams. This is so-and-so. I'm calling you because I'm losing a lot of money trading." And I say, "Oh, are you trading options or day trading?" And they say, "How did you know?" It's like I could do a psychic 900 line, right? Without even heavy breathing on it. Because it always breaks down to they're trading options or they're day trading, and those are the people that are losing money. And the other thing that I find the commonality behind that is they're way over trading. This week a guy called, he's got a $7,000 account, and he had on 6 positions on $7,000. I said, "Well, is it a little hard to focus?" He says, "It's a little hard to live." So if I was to give you any basic rule, the basic rule would be that you should probably trade one commodity for every $10,000 you have. One contract, not 2 contracts, but one contract or one commodity for every $10,000 you have. That probably means some of you don't have enough money to trade, which is really, great. Then don't trade. But like, this is a business. This is a business, and like any business, if you're not properly capitalized, guess what? You're going to get washed out. You want to get washed out? Good. Start trading with $1,000. No problem. You can do it. But the odds of you succeeding are infinitesimally small, even with the greatest system in the world. So the amount of money you have is a critical function of your success, whether it's as a commodity trader, a stock trader, whether you open up a greasy spoon little restaurant joint on the corner. It doesn't matter. Whatever your business is, if you're not properly capitalized, you're not going to succeed. And people, as I mentioned the other night, people just love to trade because this is like sex. You don't have to be good at it to enjoy it. So people just rush in and they trade anything. If it moves, they'll trade it. They don't care if they even understand it or know what it's about. And proper capitalization is just so critical to your success as a trader. So I'd like to really underscore that to you. The other thing I'll talk a little bit about is options. Now, there's a lot of people here that know a lot more about options than I do. I don't know much about options, but of the few transparencies that the maid didn't take, I did have a couple that, fortunately, I had with me. Let's start with the first one of those. Maybe even those are gone now, right? It's an option article I picked up this summer when I was in Europe. And I thought, I got to save that for seminar people. Oh, here they are. There's a commonality, I think, going through the market. Options, you can make a lot of money trading. I mean, the other common theme that I hear a lot about the markets is that the markets are rigged. They're controlled or manipulated by these people. And we know who those people are. They're the people who go after your stops, right? And how many people think they go out after your stops? Most hands go up. You know what? You people are pathologically sick. You are so paranoid. I absolutely guarantee you they are not going after your stop. That's the wrong mindset to have, and I know it. I can prove it to you because they're coming after my stops, not yours. You feel that way, don't you? I'll bet if we plug this in, it would work better. Daryl, could you find what we do with this? It's a great way to stall when you don't have transparencies, right? That must go in someplace where I don't know. Since we know that about 90% of options expire worthless, it doesn't necessarily mean it's a difficult market to trade, but it suggests that it may be. And unless you are very sophisticated and understand options, I think they can probably use to protect yourself instead of using stops. If you're long, you could buy a put. But to simply buy a put or a call because you think the market's going up or down, I think can be difficult. This kind of underscores it. Deliberate concealment and poor internal controls were behind a loss of $128.1 million incurred by National Westminster Bank Limited from options trading. So here we have a major bank. If anybody can be a manipulator or have inside knowledge, you think it would be a bank that can play around with $128 million. Of course, that's what Ted Turner is going to give away per week or whatever it is, right? Can you imagine that gift to Ted Turner's? $1 billion, $100 million a year to the United Nations? Like, I think what he should do is give it to small business people. Absolutely no homeless people. Give it to people that have businesses so they can go out and hire the homeless people instead of giving it to Swahili or someplace. Amazing gift. But anyway, here we have a great example of proof that they, the vested majority interest in the world, a large bank in England, doesn't know what the hell they're doing trading the option market. So they got to conceal it. And this is not a unique situation. This has happened in a lot of instances. So this article fascinated me. It showed, A, that people don't really have everything rigged in the marketplace, and B, option trading can be extremely risky and dangerous. And if you wonder about them versus us, one of my favorite stories is many years ago when gold was real hot. I was in New York City. My secretary called and said, Larry, there's a guy's head of Swiss Bank wants to talk with you. He's like the number 2 guy in the bank. I said, well, I'd love to talk to him because I'm going to find out what gold's going to do. Because I had no idea. I didn't have a clue what gold was going to do. I figured if I talk to him, I can find out what gold's going to do. So I called the guy up and said, well, Mr. Williams, so pleased to meet you. We'd like to hire you to consult to tell us where the price of gold will go. I was going to ask him. He's going to pay me, right? And I thought a guy that far up in a major bank in Switzerland would probably have a better sense of gold than I would. But in fact, he was as confused as I was, which underscores the point I made the other evening. The market is full of confusion. And what usually happens, there's a little bit of order to it, and we technicians try to make chaos out of what little order is there. It's a chaotic thing to begin with. The markets are actually simplistic yet extremely complex. And we technicians, people that bring in charts and computers and all this stuff, I think make it overly complex because we think the market, that we are the center of the universe of commodity trading. In my belief system is we are absolutely not the center of the universe. We're a couple light years away from the center of the universe. The center of the universe of commodity trading are the commercial interests. The reason that the exchanges were set up was not to facilitate guys with chart books. And I mean, I always get a kick out of chartists. They get their chart and they draw a line, but you can always say, yeah, but you know one thing about that line, if you do that with a number 2 lead pencil instead of a number 3 lead pencil, the breakout wouldn't be valid because it's thicker lead. Oh, I didn't think of that, they say. I mean, it's that arcane and that subjective. Yet their actual purpose is why the markets exist. It's to facilitate commerce. So I'll give you a couple of examples. This is old hat to a lot of you, but not necessarily a bad thing to look at over and over again. I'm just grabbing charts because somebody else grabbed my charts. We'll take a look at whatever this is, the D-mark. There's a major high in the D-mark back in 1995, and if we look at the commercials, which is this little line down at the bottom of the chart, the commercials were at a large short position shortly before the high. Before this low and pretty good rally, look where the commercials are, the longest long position they've been. On this big decline that starts, look where they are, the largest short position, in other words, down the lowest on this chart that we can see, for a long time period, for like a year and a half, 2 years. So I'm convinced that one of the most fundamental concepts of the marketplace is following the commercials. And a general operating rule is when they are doing the most buying they've done for the last year, the market's probably close to a low. When they're doing the most selling they have for the last year, the market's probably close to a high. It's simple. These guys know more than we know. Pure and simple. So we should follow them in terms of a long-term understanding of the marketplace. That they are critical to knowing what's going on in the market. Oh, here's one of my favorite examples right here. There's copper. Notice a little decline right here took place in the copper market. Look what happened just before that decline. The commercials were down here at the lowest level of short selling for about a year and a half since this high, when they were also at a pretty large short position, right here. In other words, this matches up with this. And if we look down here and see what the public was doing, they were also very bullish. So we have a great juxtaposition, a battle going on. The commercials are bearish. They've been the largest sellers that they have for the last 18, 24 months. And the public is the most bullish that they've been for about the same time period, about a year. So the public is wildly bullish, and the commercials are wildly bearish. Who's going to win? Evander Holyfield or me in a boxing ring? I'm the public. I think Evander probably will. I mean, if I take off what's left of his ears. That was an amazing thing, wasn't it? Well, we should still see the uninformed lose money. The uninformed, the public, you people, God bless you, have a wonderful ability to come into this business and do the wrong thing at the wrong time. Consistently. For years. One of my brokers has had a client who's traded and lost money every single year for about 10, 11 years now. 2 years ago, he talked to the guy and he says, you know, Ben, he says, I love having you as a client, but it bothers me every year you lose about $25,000, $30,000. Have you ever thought about just not trading? I said, you know, I don't have to have your business. I've got other clients. And the guy said, you know, Ed, he says, I've thought about that, but damn, I don't chase girls. I don't go to Las Vegas. I don't have any other fun thing I do in my life. So this is what I do. I says, okay, I'll take your business. But that's almost a cavalier attitude people have, like we've got to get rid of some money here or something, I guess. And I mean, this guy's not the only guy with that attitude, I think, based on the number of people I see who are losing money in the market for really dumb reasons. One of the reasons that you lose money in the market is you get very emotional. At this rally point that we saw in copper, the public was extremely bullish. Look back here. This is the measure of the public. Because the higher this indicator is, the more bullish they are. This is the percentage. 70% of them are bullish here, and like 20% are bullish down here. Interestingly enough, notice at this low where we were. Less than 20% of the public was bullish. This is based on Market Bain's Investor Sentiment Index. What's fascinating is if you think about what you learned in economics and college. Oh, I can't do that, can I? Sorry about that. Darn. Sunday morning, keep the jacket on. I should be wearing bibs and coveralls instead, right? How do they wire you up? I'm wired. You're wired, right? What? Good, because I got some great jokes I can tell you now. Sorry about that. Which one? Is that live? It's going to look good on camera. I wanted to get a little behind in my work. Okay. We live again? Great. Notice that at very low prices, we have very little public interest in the marketplace. And at very high prices, like way up here at this high, look how bullish the public was. Over 70% were bullish. Now that's really interesting. Here we have the lowest reading we'd seen in the entire chart at relatively low prices compared to where we'd been for the last half of a year. These are weekly charts. What I've noticed is that defies classical economic thinking. At low prices, there's no demand by the public for commodities. There's no interest. It's supposed to be lower prices. What do low prices do economically? Bring out demand, right? And high prices create little demand. There should be less demand at high prices than little prices. That's economics 101. It's absolutely unreal when it comes to the marketplace. It's totally incorrect. At high prices, what we always see at high prices are large interest by the public. Actually, this isn't the public. These guys are even bigger schmucks than the public. These are the guys that write newsletters for brokerage firms. And they tend to be the most incorrect crowd in the marketplace, is the newsletter writers. People like myself, people like that I've been speaking to here at the seminar. That ought to scare you a little bit, right? Whoa. I thought the guy was a little weird when he started talking about that stuff. Well, this is the measure of basically newsletters written by brokerage firms and to some extent newsletters written by private individuals as well. So when the crowd gets excessively bullish while the commercials are bearish, that sets up major plays. And the reverse would be equally true, of course. Let's see if we can find some examples of that with some other weekly charts. Yeah, here's one. Cotton. Is cotton or sugar? Not that it matters. Actually, I'm going to teach you how you read charts. I'll do that. That's the way you read a chart. See, what everybody else wants to do is read charts like this. They want to look at price action, think they can figure something out from price action. I don't think you can. I've looked at those charts for whirly-giggies, uppercase, outer Mongolian, flying boxcars, heads and shoulders, the whole deal. I can't find anything that's very consistent. I can with short-term 3, 4, 5-day patterns, incidentally. But in terms of this longer-term stuff, But if I look down here, all I have to do... Gee, we had a bear market there. Thank you. Is notice a time when the public is excessively... Hey, you guys are good. Excessively bullish up here. They're excessively bullish here. And then I'm going to look at a time when they are excessively bearish, which would be like here, in here, here, and over here. So I say, oh, look, the public was wildly bullish over here and wildly bearish in these areas. And then I'm going to look to see when the commercials are wildly bearish. Notice the commercials down here are the lowest that we've seen for a long time period. So, oh, that's probably a negative indication in the marketplace. Right here, the commercials are bearish on balance net, but not excessively. Over here, look what I've got. This is 0, so the commercials have been buyers all over here. These guys, hey, that's a set-up market. That market should rally. This market should decline. Over here, I've got the commercials very bullish again, the public very bearish. Guess what? We should see a rally in here. And the same thing over here. Then you can come on up and say, oh, look what happens up here. We're close to, in this high area of the major high in the market. Right here, we're just perfect at the high. We've got a nice low here. We've got this high here. We get this low over here. We get another buy in here. And you get a buy in here. And in each instance, you had, for this market that didn't go many places, you had a nice rally. So I really want to get those two camps diametrically opposed and at extreme levels. And that's, to me, is the best long-term stuff that I've seen. On top of that, you can put a lot of other tools like seasonals, like premiums, like trend lines, like moving averages, like everything else. But unless you get a market that's really set up for a trade, I think you're just kidding yourself to think that you can predict the future. One of my points that I made Friday for those that weren't here is that if the world were perfect, you think about that, you think we'd all be wealthy. But that would probably be the worst condition you can imagine. Because if we're all wealthy, who's going to wait on you at the coffee shop? Who's going to drive you to the airport? Who's going to fly the airplane? If we're all wealthy, nobody's going to work, right? And you think is the ultimate goal of mankind not to work? I would postulate the ultimate goal of mankind is to work. That without work, there's no value to your life. And so on a cosmic basis on Sunday morning, I'm here to tell you that God doesn't want everybody to be rich. Probably doesn't even want everybody to trade commodities, as near as I can tell. Because God keeps giving you that message, right? Some of you just haven't gotten it yet. And that is an important consideration. This business is not for everybody. Some people think that it is. Oh, I can do this. Well, not necessarily. If we were all rich, the world would be probably a very unenjoyable place. What I call the totem pole theory. There's always, you know what a totem pole is, right? With all those faces on it? Well, if you take the bottom thing off the totem pole and put it on the top of the totem pole, suddenly the bottom guy is on the top, but guess what? There's still a bottom to the totem pole. So you can never get rid of the bottom to the totem pole. The way we could all become instantly rich like that would be if we knew the future. You could be a gambler, you could play dice, you could play the ponies, you could play commodities or stocks, or you could set up a business. You could do anything you wanted to do if you knew the future. I think God is very, very protective of the future. For those of you that don't believe in God, there's no future anyway. So either way, I win that argument. That the future is very difficult to figure out. In fact, it's amazing. Big things you think that we could figure out, like you'd think that after we spent how many billions of dollars in defense that the United States government would have known the Berlin Wall was going to come down. And instead we saw it on CNN. Astounding. The 7,000 meat inspectors, federal meat inspectors we have in this country at every meat processing plant, every packing and cutting plant in the country. We have federal inspectors, yet we still had an E. coli breakout. These guys obviously weren't doing their job. We can't predict the future very well, in whatever it is. In fact, as some of you know, I'm living in Wilmington, North Carolina till Christmas. When I went from San Diego to Wilmington, everybody in the coast here said, oh, Wilmington, North Carolina, that's like the hurricane capital of the world. You better be really careful back there. You're going to have a hurricane hit. Right? Wilmington's been real nice, a little humid, but where did the hurricane hit? California. I couldn't believe it. Proves the point. You don't get to know the future very well, even if it's weather, with anything. The future is really largely unknown. That's one reason why it's so difficult to predict and forecast commodities. We just have a general idea of what the markets are going to do, and we need to play to that generality as best as we can. Now, because it's general, it's largely unpredicted, the rules are largely undefined, the data is unstable. The surest way to drive a person insane is to give them unstable data. If you want to go through the annals of psychology and read how they drive animals or people batty, it's with unstable data. One day the guy comes in and he's given a piece of candy because he picks up a spoon. The next day he picks up the spoon, they hit him on the head. Next day he comes in, he picks up a spoon, nothing happens. The third day he comes in, they pick up a spoon, and they torture his friend or something. And after a while, no rules, the person doesn't know what's happening, and the human mind can't handle that. It's been proven with people as well as animals. Well, what we have is unstable data. One day it looks bullish, right? You buy it. The next day you lose money. The next time the same thing looks bullish, you buy it, you make money. So there's a huge unstable data out there that triggers every emotional, psychological malady and problem you've ever had in your life, all comes to the forefront of trading. You sound like you've been in therapy with me. It's incredible how that happens. So you need to handle the psychology, the psychological part of trading as well. And I can break that down into two areas. One is the overtrading I touched on briefly, and the other is, in the drug culture they say speed kills. Well, in commodity trading, it's greed kills. I've done a lot of work on this, and I really know one thing about the markets, and that it isn't that fear that gets you in problems, it's greed. You people are so greedy. That's why you got into commodity trading. You want to make a lot of money quick. So you're highly motivated by greed, and you need to understand that. And what happens is you think, oh, I finally figured out how to trade. You put all your money on one trade. I used to do that. And that one trade would be right, but if that's your game plan, essentially putting all of your money or the vast majority of your money on one trade, that'll work for 2 or 3 trades, but there's always that one bad trade out there looking for you. And it's going to come find you quicker than you think. That's why money management is so important. The most important voice is that one of, when you hear it says, oh, plunge, this is the one. That's a voice you have to be very careful of. So you really have to listen internally to yourself, your own self-dialogue. Now, in athletics, we do something called modeling, where you look at how somebody throws a football or find out what their mindset is, and you listen to that. People listen to tapes to get their mindset on what to do. I brought a guest speaker today who's going to share with you her words on money management, which I think you'll find fascinating. And if you can just remember what she says and listen to the voices that she's going to give you, I think you'll find the next time that you start overtrading or getting what I call a King Kong feeling, that you may feel, you're going to say, oh yeah, that's what Larry was talking about. That's what the lecturer was talking about. So I'd like to introduce one of my favorite speakers now. This is Miss Piggy. And when you hear Miss Piggy speak, that's the voice. That's all you have to look for to be a successful commodity trader. See, it's when the tail wiggles, that's you saying plunge. And I mean, Miss Piggy is the best speaker that I've ever heard speak. The whole lesson is right there. When the nose starts to wrinkle up on you, that's the message. That's the only voice you have to hear. And you'll hear that voice inside of you. And it comes at a time that you've been highly successful. The worst position you can have in the marketplace is to have a lot of winning trades. Nothing is more detrimental to success than winning trades, because you think, I finally got it figured out. But remember, one of my basic datums is that the market is full of unstable data. So if it's full of unstable data, all that's happened if you've had a string of winning trades is, you know what? You got lucky. But you guys think, no, I got brains. Never confuse luck with brains. And you think it's pure, it's my skill, I finally figured it out. After 35 years of trading, I finally recognized I don't have any great skills at all. I just get lucky every now and then. And as soon as I've had a bunch of luck, I better be really careful. The position of affluency is one of great caution and danger. By the same token, the neatest position you can have is a position of a lot of losing trades. Because you're either going to get tapped out or you're going to get a bunch of winning trades. And that's part of the mindset that you need to have as a trader is, hey, it's okay, this is a business of pain. If you're not into bondage, I guess you shouldn't be trading commodities. Maybe Marv Albert would like commodity trading. I don't know. But this is not the concept, I think, of trading that people have given you is basically it's a straight line business. You come in, you make a lot of money. And the truth is that that's not true at all. You make money, you lose money, you make money, you lose money. You go through a lot of pain in this business. And if you can't stand that pain, you're going to get shell-shocked at some point. You're going to lose your focus at some point. You're going to get out of the business. You won't stay with it. One of the things I tell myself at the first of every year is that I'm going to have 2 or 3 equity drawdowns this coming year. And I'll probably see 30 or 40% of my account eroded. But I pre-frame myself for that, so when it occurs, oh yeah, that's this business. That's the nature of this business. And most people that talk about this business, they give you the idea that these drawdowns don't really occur. Have any of you traded at all? Have you ever had a drawdown? Well, have any of you had a draw up? Some have had draw ups even. But when it happens, you get shell shocked. So you need to pre-frame yourself that says, hey, this is part of the business. There are drawdowns, there are draw ups in this business, and I better be prepared for the drawdown emotionally so when it happens, I can stick with my game plan. Because most people during that fire and brimstone period of drawdowns get emotionally frizzled and they can't continue with their game plan, which is why money management is so critical. So I'm going to talk a little bit about money management, then we'll get into systems. Without money management, I think you might just as well give your money to me or to some charity. At least you'll know where you lost it. It would be easier to do that than to continue trading. Without money management, you're just about going to be dead. Because with systems, you can do anything with systems. With a computer, you can make anything look like it's a winning system. Have any of you developed trading systems? Mike, you have. A couple of the other people have, right? Well, see, the thing I found about commodity numbers, you can take all these commodity numbers and put them in your computer. They're like prisoners of war. If you beat them often enough, they'll confess to anything. You can make anything look like a decent trading system. We know, mathematically speaking, that you should have approximately 30 instances of something to take place before you can make a judgment on it. Is that basically right? Those of you who have had a lot more math than I. It's called sample size. You have to have a sample size of some number before you can make a decision on it. Well, that's true, and it's a lie. It's a lie in that I developed a system trading coffee one time. It had over 1,000 trades. And it didn't hold up for even 3 trades after that. The system never made a nickel after the test period. Though it had 1,000 trades, huge sample size, based on just the massaging of numbers, and it didn't hold up. Contrast that with the story some of you may have heard me tell about a guy who was in his house, gets out in the morning, walks out of his house. He walks by a red house with a white picket fence, and there's a Doberman pincer. As he walks on out, the Doberman pincer comes out, grabs his leg, rips it up, 466 stitches in his leg. He's got to go to the hospital. He's got to get a tetanus shot. They sew it up. They do everything. He's in the hospital a week. They take him back to the house. He's back in his house. His leg finally gets healed. He says, I'm going to go for a walk today. He comes walking out of the house. There's a red house with a white picket fence and a Doberman pincer. Do you think he needs to do this 29 more times to get a sample size? I'll bet not, right? What do you think? Probably not, huh? So sample size, if you don't have a theory, maybe you do need a large sample, but even a large sample may not prove anything at all. I'll try to give you an example of that. I gave somebody an envelope in the back of the room earlier. Are you still here? Don't do anything quite yet. She has in her hand an envelope. Don't open it up yet. We're just going to randomly get some numbers here. I like the big number, like 1 for $1 million, so I'll start with 1. Now, would you stand up and point to anybody in the room and that person tell me any single-digit number? Go ahead. Any single-digit number. Another 1? Okay, and let's do that with somebody else. We're going to get a bunch of these numbers here. Point to now you point to somebody. So this is totally random. 7? And somebody else? Now you point to somebody. 4 and 1 more. You point to somebody. 9. Now, none of you knew this was going to happen. Is that correct? A totally random number. This is a random number generated as possible. Man, would you open up the envelope? And you're going to see a bunch of numbers on there. Just hold that up. It's a business card. Walk around, hold up here, walk around the back, and then come up over here. Hold it up so they can see it, of course. Then walk around to the back so they can see it in the back, and then come on up over here and join me on stage. And come all the way up over here now. Come on over here. We'll see how close those add up to the number that we've got there. Oh, we'll be here forever. Just great. Okay. They may not have that much tape in the camera. Okay, come on up with me. What I'd like you to do is write the numbers down so everybody can see them. Okay. Okay, so the first number, get over here, is 2615 and 5372. Yeah, you got them. So there's okay, good. And the next number is just going to be 638. Actually, you'll have to put 638 like that. Yeah, 6 with a 3. Yeah, there you go. 638. And then 3124. And now would you add those numbers up for me?
In each column?
Yeah, just total them. Just come down this way. We're going to have 5284. We're going to carry our one up there, right?
Okay. So you have to be clear about these details.
Yes, I'm sorry. The 1, I think. Yeah, 1. And that should be a 1 also. This is a 1. That's a 1.
This is a 1?
Yeah.
How did you get a 1? Because that's 10 and that's 7.
Was 7 right? Okay, put 7. I'm sorry, you're right. 7. And then the next one? 1, 1, and 7, 4, 9. Thank you very much for the help. I appreciate it. Notice what we did. A totally random number that was generated that added up to the exact same thing that we're able to do with the card that she's been holding for the last 45 minutes in her hand. So like I said, you can do anything with numbers. The number couldn't have been more fairly selected than the way we selected it here. Yet it totals the number on the cards. So numbers and math can be very misleading. That's why I think you have to have an absolute truism about the marketplace if you're going to develop a system. Now, the only place that differs is in money management. When you're developing your system, you got to be scared to death of numbers. When you're using money management, the numbers are absolute and true and precise. So there is in the difference of the mathematics of the marketplace. The mathematics of money management really get down to doing a very simple thing. Which is this: increasing your number of contracts as you make money, as you gain, decreasing as you lose. In other words, if I start an account with, say, $50,000, just doesn't matter what the number is, and suddenly the account is worth $70,000, I need to trade, and I'm trading X contracts, I need to trade X plus contracts at $70,000. If this 70,000 now dips to 60,000, I need to trade X minus number of contracts. That's how you really make money in this business. As I demonstrated the other night, you don't need a very good system to make not a little bit of money, but millions of dollars of money with a good mathematical money management model. As some of you know, the Robbins World Cup Trading Championship this year, my 16-year-old daughter's in it. All she's done is follow a hotline. She's taken $10,000 to $62,000 so far. An account I'm trading has gone from $50,000 to $500,000, just a little under $500,000 since January. Not because of any brilliance of the system. I'm going to teach you most of what's in the system in a moment. But because of the money management. The money management is what's going to make you extremely wealthy and highly successful. It isn't the system. And everybody that I see, it's amazing. What you're focusing on is a system. And even in the system, what you're focusing on is the entry rule. By the time you guys get in, you forget that the most important thing is the exit. But everybody, like I said, it's so much fun to trade. You guys just want to get in and then see how you can handle this thing. And it's the exit and the money management that are critical to your success as a trader. Now, unfortunately, my transparencies aren't here. Glenn at the Genesis booth may have some software that demonstrates it over there. What you can see is adding at different values. Ryan Jones, I don't know if Ryan's speaking here or Ryan's around. Ryan's got some formulas for when you add. Ralph Vince has got some. The nicest one I think I found is simply this for most of us. We're going to take your account balance times a risk factor. And this is going to be different for everybody. She may want to have less risk than he wants to have. You might want to have a huge amount of risk and somebody else wants to have very little risk. So this, you can tailor this to you or even tailor it to your system that you're trading. That's what the software lets you do. Let's say, generally speaking, though, we're going to take about a risk factor of 20%. So if my account is $50,000, I'm going to take 20% of that, or $10,000. Then, and this is the big number, so critical, I'm going to divide that by what I think is the most important figure that I know of in terms of money management. Now, this is just so critical. It is the largest loss in your system. If you don't have a system, you're going to have a dollar stop loss, so you know that you're not going to lose more than whatever your stop is, the maximum stop you will allow. So your stop, in my instance, I want to stop of probably about, in this case, let's say $2,000. So I'm going to divide $10,000 by $2,000, which tells me I can trade how many contracts? I can trade 5 contracts, right? Is that correct? Yeah, 5. Now, if my largest loss was $5,000, I could only trade 2 contracts on the $10,000. See how that works? The largest loss is the Bengal tiger out there that wants to come jump and grab you and eat you up and claw you to death. It's the largest loss you must protect yourself from. It's not drawdown, because drawdown may take over a period of time and it's not a big hit at a time. The problem with money management is what I call getting out on the end of a limb and sawing it off. You're suddenly out there trading 200, 300, 400 contracts, and you get the largest losing trade. And because of slippage, and because of bad fills, and because of commission, that largest losing trade is now $8,000 or $9,000, because that's the morning you forgot to put in your stop. And then you're hit on a 400 or 500 lot position with a huge loss, and you go right back down to where you started from. I know. I've done it. When Ralph Vince and I were trading Optimal F or Kelly, it was not unusual to bring small accounts, $3,000, $4,000 accounts, up to $60,000, $70,000, $80,000, $100,000, and then see them go down to 10. And we couldn't figure it out. Finally, Ralph and Ryan Jones stumbled onto this idea of the largest losing trade is what bites you, what kills you. And that's what we need to protect ourselves against. And my experience from trading is that if you do that, if you take that, your risk factor, whatever it is, and divide that by the largest loss, you're then prepared yourself for the risk you're willing to assume, the risk factor, divided by largest loss, you're now prepared for that risk without demolishing your account. And you can, of course, adjust this risk factor in whatever fashion you want to. I can give some examples of, unfortunately, those are the transparencies that are missing, but I've got the hard copy of them here. A couple little systems that a system that makes about $60,000 trading the bond market goes to making about $6 million. just because of money management. In other words, go from $60,000, same time period, to $4 or $5 million because of money management. A slightly different money management, and you take it to only $1.4 million. Another money management, you take the $60,000 to $277,000. Another form of money management, and you take it to $3.2 million. And there's one where we get really blown away. I think it makes like $19 million. That's assuming, of course, that you're going to trade an unlimited number of contracts, which you're probably not, but it shows what happens that you trade 1,000 contracts at the most with the system and money management. But clearly that money management formula is what's going to accentuate your growth of your account. It is not how good you are in the market. Get that totally out of your head. That's the wrongest notion that we all come into this business with is, I've got to figure out the market. You don't. All you have to do is figure out money management and then figure out some little thing about the market, and you'll be way ahead of the game. Are there any questions on the money management thing? It's so critical. Please. Yes? Pardon? Okay, let's say on this trade is a losing. We've lost $10,000, so our account is now at what? $40,000, right? So we take 40,000 times 20%, that's $8,000. Divide that by 2. Guess what? We're going to trade 4 contracts. So you keep coming down, boom, 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 and you keep working it up the other way. If the account went to $100,000, 20% is 20,000 divided by 2. We now get to trade 10 contracts. The other thing that we... Yes, please. Pardon?
That future prices are going to remain stable from the past data.
No, this is money management. The money management formulas are hard, they're faster, and cement doesn't matter. Hopefully the system will hold up. We'll get to the system in a moment. But these numbers are absolute. They're not like the random number that we generated. These are absolute numbers. And they will work, that's math. And there is an ultimate way of trading your system. The neat thing is now, thanks to the software that Mark Thorne developed, is that now we can find out what it is. The big thing when Bill Cruz started Omega was we didn't know systems. We didn't know how to test them very much. We couldn't computerize, and the average guy couldn't. And then we all developed systems. Then I think the next wave is, okay, now we have software that tells us exactly the best way to trade a system. And that is hard math as opposed to almost artsy-craftsy math. Please? You have to speak a little louder. The risk factor? Yeah, the best way to determine risk factor is right here in you. Your risk factor, how much do you want to risk? And your system will also tell you, at one risk factor, your drawdown is going to be 70-80%. At another risk factor, it might be only 30%. I like about a 30% risk factor, 30% drawdown, so usually the 20% risk factor is about the best. Al?
Larry, I got $50,000. I lose 10. I've got 40. I put on 2 contracts. How do I get to $6 million?
Well, hopefully what happens is the next trade, so you're now at $40,000, right? And you've got, how many contracts on it, you say? 2? No, we actually would do, if we're doing the $2,000 loss, which is what you should have, not a $5,000 loss, you're going to be trading 4 contracts, right? So you've got 40,000 contracts, you've got $40,000, 4 contracts on. Hopefully, the next trade is a big winner. Say in the bond market, you pick up maybe 2 cents. So you got 4 times $2,000. So you've got $8,000 now. Pardon? No. Now you close out that trade, you're at $48,000. Great. 20%. So you get to $9,600 divided by 2. We're at 5 contracts. Hopefully that trade's a big winner. At $3,000 per trade times 5 is $15,000. So you've gone from $48,000. You add the $15,000, $63,000. Now you lose the next trade. You're going to lose, and you're going to drop this down to maybe $55,000 or $60,000. But that compound growth is really what you're doing. The magic of compounding, that will take it to astronomical numbers. That's what we've done. What Michelle has done in her account is she started trading one lots. I've got I showed it the other day. I've got all the confirms right here. You can look at them. You can see how she traded it. Starts out trading one contract. In January, the account is the end of January is $9,200. We lost money. The end of February, it's $15,000. Suddenly, we're buying two contracts. In March, it's $17,000. Guess what? We're buying three contracts. It's $21,000 in April, and we've got six contracts on because we're really pushing. We want to win a trading championship. Now the account goes down to $19,000, and you see two lots. Then the next month, the account is at $14,000, and you only see one lot. Then we get back in gear. We got a $26,000 equity, and you see five lots. Then we're at $52,000, and you see eight lots. So that's how you get it to the big money, is by staying with that fixed percentage, watching out for the largest losing trade. And as you start to make more money, you're going to be trading a lot more contracts. But not on any one trade. On the next trade you take, you'll take more contracts. Question? Pardon? No, I don't. No, I don't. It's not in the hotline. Money management is an individual thing. She's been following a hotline. That's all she's done. Immaterial. The hotline's not the issue. It's the money management. Her dad's. Who else's? I mean, how would I feel if my daughter followed somebody else's hotline? Oh, heaven forbid. I'd kick her out of the house. She'd be black and blue with wealth. You kidding? Woo! Question?
I want to make sure I understand the money management. Okay, you got 100,000. No, forget it. No, okay, 100,000. 20% of that is 20,000. Now your largest loss is going to be 2,000. Now you take 2,000 per contract.
No, just divide 2,000 into the 20, and that will tell you how many contracts to trade. Right. Yep. That's all you got to do. Question. Would you increase the... Well, your largest loss is something you get to control because you get to use stops. So why would you want to... That's the trouble with a lot of systems. In system evaluation, for a while we looked at percentages, accuracy, drawdowns. Finally, what you need to look at, what's the largest loss the system had? Then you can tailor-make a trading, a money management system for it. But I developed some great S&P systems that are wonderful, like 90% accurate, but they got an $9,000 loss in it, and whenever that loss came, it blew us out. Because invariably, I was out on the end of a limb with 150, 250 S&P contracts, and I got an $8,000 or $9,000 loss. Well, bye-bye money. I mean, over and over. What the heck's going on here? Finally, thanks to Ryan and thanks to Ralph, the answer surfaced. Please.
Larry, if you look at any type of system where you modify the biggest loss to the type of contract, I'm not going to put a $2,000 stop on those. But a $2,000 stop on the S&P, you're going to get stopped at probably.
Well, right. You need to develop your system and then try to get as close of a stop as you can. Because obviously, the smaller your stop, the more contracts you can trade. Ooh, that's a really interesting concept, huh? Which is why right now I don't even trade the S&Ps. Because to trade the S&Ps right now, your stop's got to be about $4,000. Why would I want to trade the S&Ps with a $4,000 stop in it when I can trade bonds with a $1,600 stop in it? I'd a lot rather trade bonds. So that will tell me where I should be in the market as well. And clearly, if you're going to trade oats, you don't look like the type of guy who would trade oats, but let's, for the benefit of a doubt, just as an example, then in that instance, your system is going, the market's volatility will tell you what your stop should be, and then that's going to tell you how many contracts you can trade. Obviously, a more volatile market, the beauty of this math, the more volatile of the market, the S&Ps, the fewer contracts you should trade. We know that, but we don't do it. But now we say, oh yeah, it tells us that I should trade fewer contracts, so my stop's got to be larger now. So it works itself out.
One question on stops, Larry. Elon, for example, start with a $1,600 stop, starting at zero when you get in. As you start making money in your
absolute. You're 16. Well, not as I'm not going to lose more than $1,600 per contract on a trade.
So if your position goes up, you raise the stop.
No, I don't raise my stops. I may or may not, depending on the system, but I usually don't. I usually just keep it there. Please.
Now, there are some instructors here that will say that you shouldn't have more than 5% risk if you want to be around more than 3 years from now, because it's not improbable that you're going to have 5 or 6 losing trades in a row.
Yeah, that is an old adage that you should not have more than a 5% or a 10% risk. But if they don't know what their largest losing trade is, or let's take an example. You've got a $50,000 account, right? And your risk is $5,000, which is going to be what? $2,500? How can you trade that if your largest loss is $5,000? Can't even trade, can you? Or worse yet, let's say that it's just enough to trade one contract. Let's say you've done 10%, this is $5,000. But your largest loss, I'm just using a hypothetical example here, is $20,000. Guess what? You're trading one now that what you thought was a 5% loss is actually a 20% loss. Because the largest loss that you are going to experience is so critical. The most important number you can walk away with from my presentation is understanding that largest loss. Do you see now the difference that can happen? People say, I never put more than 5% of your money in the market. Well, we can use the numbers to show the other way that you'll never make any money with 5% either. In fact, if you want to come up, I can show you where we've done those simulations with... here's where we're risking, we're only using a 10% amount of money. The system makes $15,000. But with a 20% risk factor, it makes $250,000. I think I heard one time, nothing ventured, nothing gained. You got to risk something. That's probably true trading commodities. And 40%. Pardon? 40? Well, I think it all has to be tailored to what your losses, et cetera, are. You can risk too little, is my point, or you can risk too much. You have to find that happy medium. Happy for you emotionally and also statistically. That's what you're really looking for. Pardon? Any books on money management? Well, I think you just got as close to the Holy Grail as I know. But the software Mark Thorne's got lets you do so many incredible things. Or the books by Ralph Vince and the works by Ryan Jones. The neat thing about the software is it will go through, like my systems have maybe 5 or 6 rules in them. It'll tell me which ones are the strongest rules. Or it'll say if you've had 5 losing trades in a row, do you want to increase or decrease the number of contracts on the next trade? If you've had 7 winners in a row, do you want to increase or decrease on the next trade? That's how it just opens up this whole new arena to study how we should manage our money. And I think that is a real point of demarcation in the future. We're going to know what we should do with our money. In the past, you guys just taken the dice out and rolled them. And you say, oh, I feel really bullish. You bought more contracts. And it may have been that you just, you had too much coffee that morning, so you felt real good. I've done that. It feels, I'm so powerful. You realize the caffeine high. Costs a couple $100,000. You think Starbucks is expensive. It's cheap compared to over-trading on caffeine. Please.
Do you have any comments on the relationship between risk factor and drawdown?
I'm inclined to think that drawdown doesn't matter very much. I've done tests where we'll take the account balance time risk factor, divide that by drawdown. It doesn't make as much money. Because a drawdown, obviously, if the drawdown in a system is, say, $15,000 and the largest loss is, say, $2,000, but I divide 15 into my trading unit, I'm not going to get to trade very much. So it's too slow. I used to think you need to do margin plus drawdown, but it's too slow, or at least for me. Maybe not for you, but for me. So largest loss seems to be, we batter up all these numbers like those prisoners of war, and that's the one that keeps coming back and says, this is pretty good stuff. This is pretty good stuff. There's some other things you can do. The more sophisticated thing is to see how your system trades. What's the average length of time and losers? Another interesting thing we found, if you've gone in a decent system for X number of days without a large winning trade, you've got a large winning trade coming somewhere pretty soon. And if you've gone for a long time without a loss, guess what? You're going to get a lesson in humility. So you can learn how that system works and develop money management according to that as opposed to the other things I've talked about. Well, so what we've learned is that we can't get too emotional. We need to have a money management program. We can't overtrade the market, that this is a business. It's about money. It's not about having fun. Now, in the last half hour here, it was over at 9:30. Is that right? Does somebody know? Okay. I'm going to talk a little bit about things you can trade with, because I know that's what you really came for. You didn't come to hear about money management. You came to learn how to buy the lows and sell the highs. Right? Yeah, you can admit it. I've made a lot of money trading. Millions of dollars trading. I can think of only one market low that I ever bought in my life. What's ironic about that is out of thousands, millions of trades, I've only bought one low. You'd think statistically, based on the little trick we did with the numbers at least, I'd get more than one low, right? It was a low in cocoa years ago. Al, I got that when I was trading the stuff in Palos Verdes. Bought one low in my life. Just throwing a dart, I should have done better than that. So I'd like to suggest to you that the idea of buying lows may be more difficult than you've been led to believe. And I don't think I've ever gotten the high. Well, I sold a lot of highs, but it turned out later on they weren't highs. Markets went substantially higher. But I sure thought they were a high at the time. So it is extremely difficult to do that. My belief is that all the, what I call the arcane, the mumbo-jumbo, psychobabble stuff about the markets being able to be predictable to a gnat's eyelash are totally erroneous, totally false, totally misleading. And the sooner you get that notion out of your head, the more quickly you'll make money. It's kind of based on the W.D. Gann story. W.D. Gann supposedly called the exact highs and lows of the market. Well, let me tell you something. Let me make this real clear. I knew W.D. Gann's son when he was alive. He was a broker in New York City. I knew W.D. Gann's promoter and business partner. And the stories about W.D. Gann are incorrect, factually incorrect. He didn't do those things. He was a brilliant guy. He had some chartists. He was pretty good in the market, but he didn't do those things. He had a great press agent, F.B. Thatcher, and F.B. set up the stuff and made it look great. He had a great, especially back then, you didn't have the press like we have now, and you could get stories planted in the media, and he did. That was it, pure and simple. So nobody's been able to duplicate that. And I don't mean this in a braggadocio fashion. Nobody's been able to do what I did trading in the Robbins World Cup Trading Championship, taking $10,000 to $1.1 million in a year. I don't think anybody's even done what my daughter's done yet. $10,000 to $62,000 in a couple of months. And that's without magic, without trying to predict the highs and lows. That's just following the system in money management. So I would believe that that's a better example for you to follow than trying to get absolute highs and lows in the marketplace. This is not about trying to be right. As a matter of fact, to me, the frustrating thing about my life as a trader is you can never be right in this business, ever. You'll never be right. You'll always get out too early of a winning trade. You always got out of a losing trade too late. So far, every losing trade I've ever had, I've had too many contracts on. Every winning trade, I've never had enough contracts on. Right? So you're never right. But the human mind has this thing, it loves to be right. Get rid of the idea of right in the marketplace. This is not about being right. It's about making money. But you people want to be right. You want to call the lows and call the highs. And I'm saying, yeah, it doesn't matter. You don't have to be able to do that. Calling highs and lows is a futile way. It's a great way to get deficits. It's a great way to get margin calls. So forget about that. Let's look at things that really have an impact on the market. And I'd like to show you the market that I think is a great trading market right now is a bond market. And there are a lot of things that affect the bond market, and I'd like to share with you one of them. This is something a friend of mine, Marty Zweig, did a while ago. This is the relationship of gold to the bond market. And just read what Marty wrote. Gold prices have gone down sharply the past couple of months. This is a recent letter. The year-to-year change in gold is now below 15%. Since 1972, when the year-to-year change in gold was below 5%, the total return on bonds beat cash by 11% a year. In the -5 to plus 15% gold range, the total return on bonds was only 3.2%. When gold was rising by more than 15% a year, cash beat bonds by 7%. When we checked the relation of gold versus stocks, similar relationships. So when gold is going down, bonds tend to rally. Now that's a fundamental axiom that's true. There's a real relationship going on between bonds and the gold market. When bonds are when gold is an uptrend, most likely bonds are going to be going down. That's a truism you can trade with. That's something you can build the base of a system with. That's real. That's real. It's not, gee, do I use a number 3 lead pencil or a number 6 lead pencil to get my trend line? Which one's going to work the best here? This is not curve fitting. This is a real fundamental consideration of the marketplace. That is much more impressive to me to develop something based on that than to just try to run numbers through the computer. That I would rather you focus your research on those relationships. I would rather you purchase systems and go to seminars and learn about the relationships in the marketplace. Some great sources for that. Maria Ruggiero has done a lot of work on that. John Murphy's done a lot of work on that. I think you're going to see a lot more work done on relationships, how one market affects another. By and large, I would point out to you that markets are influenced by interest rates. If you want to look at the wheat market or soybean market, all you have to do is run a spread between wheat and treasury bills or wheat and treasury bonds, and you can almost see when the money comes into the wheat market or when the money leaves the wheat market because it's going to go into treasury bonds. You can watch this flow of money between those two markets. And it's a wonderful, in fact, I've written an article for Omega and Futures. It'll be out. I can tell you when it'll be out in their book. And you'll see what I call will spread. And you can just see this spread relationship of these two markets, how it works. That there's a strong, powerful influence supporting the markets. Money has a choice of being in a safe haven, bonds, T-bills, or in something risky, oats. Or not quite as risky as oats, whatever. So look at that relationship. What's stronger than T-bills? That's a buy. What's weaker than T-bills? That's a sell. Then you're trading with a truism of the marketplace. In the S&Ps, I can tell you a big secret about the S&Ps. It's that, and especially this Dow contract is going to start trading now. The Dow contract is going to be, I think, a wonderful trading vehicle, incidentally. I mean, right now, if I tell my neighbors I trade the S&P 500, they look at me like, what planet is this guy from? You know, you go to a cocktail party and say, I'm an S&P trader. First of all, they think it's like S&W canned beans or something, you know. I have no idea what it is. But if you say, yeah, I trade the Dow, I mean, everybody knows. All around the world, they know the Dow. So I think you're going to see the public come in to trade the Dow, and you'll see much larger volume, more interest in this market than we've ever seen before. I think it's going to be a hot market, and we may well see the S&P become a thing of the past, like the value line became a thing of the past. So really pay attention to the Dow. But what moves the S&Ps, what moves the Dow, is the same thing. It's the bond market. And the basic axiom is what I call, I'll show you what I call it. If the best sell signals you're going to get in the stock indexes, it's going to look like this, the best sell setup. If you've had stock market rallying like this, and the bond market coming down like this, that's negative. The stock market's probably going to come down because bonds pull the stock market in a direction. And as a matter of fact, I call this the jaws of death because those bonds are going to snap down that jaw of the S&Ps. Just look at the S&Ps the last 30 days. Where did all these horrendous declines come? They came when the stock S&P is rallying and making new highs, and the bonds aren't making new highs. Then the S&Ps took their smashes on every instance. The last recent rally, the S&Ps came down like this. They looked a little weaker. The bonds were doing like that. Boom, up went the S&Ps. There is such a powerful relationship between the S&Ps or the Dow now and the bond market. That's the fundamental consideration you can trade on. And trust me, when you're trading large size, which for some of you is one contract, it doesn't matter, you feel a lot better because you know you're trading with a truism as opposed to you're trading with some little whirligig thing you notice on a chart. Not that the whirligigs don't have their place. They can have their place for timing your entry once you see a consideration. But without the consideration, I think you're wasting your time. You're chasing, as Tom DeMark says, great analogy. You're trying to play pin the tail on the donkey, and the donkey keeps moving. And you've got a blindfold on as well. And that's really tough to do. So I want to have a real consideration in the marketplace that affects the market. Then I'll bring in all the other stuff to try to trade with. The reverse is equally true, of course. If bonds have been going up and the S&P have been coming down, then expect a rally in the S&P market. Generally speaking, you can look at a 6-day time frame. Did an interesting study a couple of years ago where we took the S&Ps and just bought the S&Ps on the opening every day and got out on the close every day. It actually made a little money because we've been in such a strong bull trend. I think it made maybe $27,000 after commission, but it had a drawdown of probably $50,000, something like that. We changed one rule. Still bought on the opening every morning, got out on the close every day, every single day, come hell or high water, it didn't matter. The only rule change we made was the bond market had to be, an 18-day moving average had to be higher today than yesterday. In other words, bonds were in an uptrend. Then and only then would we buy the S&P on the opening and get out on the close. You see the difference between those two systems? One system is going to buy every day, one only if the bond is an uptrend. All of a sudden, it makes like $120,000. The average profit is $120 per trade versus being like $9 per trade on the other one. And the drawdown's cut in half. That's the impact, the power that the bond market has on the stock market. So whatever you're doing, any stuff you purchase here, develop on your own, if you want to make those signals even better, back it with the bond market. Then you're really trading with a fundamental truism, and I think you're going to find larger average profit per trade, which is critical to your success, higher accuracy, and smaller losses. So I would counsel you, admonish you, to make certain that you're looking at that relationship to trade the Dow of the bonds versus a Dow. A simple one I pointed out the other day is simply to buy the S&P on the opening every single Monday if the bonds are in an uptrend, and the S&P's open down. So the S&P's opening down on a Monday, and bonds are in an uptrend, you can buy that weakness. And those of you recall that made about $68,000, I think 56% of the trades were winners, about an average profit of $250 per trade. And that's something I've taught for years now, maybe 6 or 7 years. Still continues just cranking out money. Sure. You're going to buy on the opening Monday, if and only if it opens down, and the bond markets are in an uptrend, basically an 18-day moving average. That makes about $66,000 or $68,000. Real simple system. And you guys say, oh, come on, Larry, I want something better than that. If you combine that with money management that I just explained to you, the $66,000 or $68,000 goes to like $9 million since 1982 with money management. So it's the money management that really made it make the money. Please.
You're not going to do like an up and wait for it to come back up?
Well, I'm not even going to get that complicated. I'm taking the most simple system. What I want to establish, you don't need a complicated system. You don't need to be real fancy. You don't need to call the highs and lows of everything. Don't even worry about that. We're going to buy the opening on Mondays if the bonds are in an uptrend. We're going to get out on the close. We're going to have a protective stop of $2,700. That's it. And toss that in with a little bit of money management, and maybe I can find. Really sorry that I don't have the transparencies. But we'll get the numbers of what it did. S&P buy in the opening Monday. Yeah, it takes it to $6.7 million. That's not bad, huh? But it isn't the magic of the system. It's what happened with money management. So you can imagine if you even had a better system, what you could do. But I'm saying you don't need to have any great system. In the bond market, a system that, again, I've taught for years, is you're going to buy the bonds around the end of the month because bonds usually rally at the end of the month. So do stocks because bonds rally. So about the 18th trading day of the month, you're going to buy bonds. You're going to hold on to them for about 3 or 4 days. And also, when gold is in a downtrend, you're going to buy bonds on Monday if they open down on a Monday. So it's like our S&P rule. If bonds open down on Monday and gold is in an uptrend, the 18-day moving average higher today than it was yesterday, we're going to buy bonds on Monday. Now, bonds you can't day trade like you can the S&Ps, and I want to talk about that for a moment. So I'll digress here for a second. This is an important lesson about markets. How many trade the S&Ps? Have you noticed that they move a little quicker than the bond market? Like a lot quicker, right? Like, boom, you can lose $2,000 or $3,000 before you hang up the phone trading the S&Ps. In the bond market, $2,000 or $3,000 loss, that's going to take some time. Whatever market you're trading, you need to think of it just like a seed that you plant in the ground. We've got some farmers and ranchers here. And we've got any farmers here? What do you raise, sir? Pardon? Corn? Okay, now tell me about corn. I don't know a lot about corn, but when you plant that corn seed in the ground, you plant it, do you go out the next morning and see how it's doing? You don't. You don't go out like 15 minutes later and check on it? You run a three-day moving average of it? That's what day traders do, right? They're out there checking that thing every time. What would happen if you did that to your corn? I'll bet it wouldn't grow, would it? In fact, you'd get so nervous, you'd say, look, Ma, it's not growing. We better put in a new crop. And you've got to give markets based on what they are different time frames. It takes longer to raise, to grow corn than it does to grow, what else are you growing? And which takes the longest? Corn, okay? So you would treat corn differently than tomatoes. Bonds move slower than the S&Ps. So while I'll get out of the S&Ps on the close or maybe sometime tomorrow, I need to give bonds a little time to grow. So my average length of trade in the bond market needs to be a little longer. That's a great secret to developing a system for trading the bond market. You're not going to try to get out in 1 day or 2 days. You might want to hold for about 3 days in the bond market to boost up your average profit so it's large enough to make it worthwhile to trade for. In the case of oats, your probably average length of trade is going to be 67 days, or, if it's a slow market. And that's a critical thing to look at, is how long do you need to be in that market based on how that market is volatility, if you will, or how it grows. So in the bond market, I want about 3 days in a market, 3 to 4 days. I need that window of opportunity for it to grow, to germinate. Whereas in the S&Ps, hey, they got Miracle Grow fertilizer on that sucker. It goes in a hurry. So my exit rule will look at the volatility of the marketplace. And generally speaking, I want to be out within, the way I trade, about 3 or 4 days in the bond market and maybe 1 or 2 days in the S&Ps. And when you're developing systems or looking at systems, it's a critical point to look at. It's how much time do you need to give that market. Okay, so once we've established our time frame for our exit, we've got our entry frames. Now all you need to do is just simply get in and buy it. Hold on to it. And that's hard. Most of you buy it, and 10 minutes later you're calling your broker back, and you want to do this and do that, and you've totally lost why you got into the market because it's moved against you 3 ticks, and you're selling, get out, get out. I think most people follow the market way too closely. You guys love to get glued to screens, to telephones, to every possible communication you can. My sense is the more communication you have, the more trouble you're probably going to get in the marketplace. The way I actually trade is I place my orders in the morning, and then I'm gone. I might watch television. As some of you know, I'm a marathon runner, so I'll go out and I'll have a nice long run in the morning. Of course, there's a lot of phone booths where I run. But that's the trouble in North Carolina. The damn phones there all take a quarter for an 800 number call to my broker. So I'm the heaviest runner out there. You can hear Larry coming, jingle, jingle, jingle. I might call a couple of times during the day. That's it. And then at the end of the day, I get myself prepared, place my orders, know what I'm going to do the next day, then I'm done. So often, we do real-time trading seminars, which are a lot of fun. We're doing one in November where we teach for a couple, 3 days and trade real-time with our money. And what I see is people can't hold on to the positions. Invariably, as soon as I get a large winning trade going on in the account, people say, get out, you got a profit. I say, no, the rules are such and such. They don't want to follow the rules. They want to take a profit and miss the big days. You've got to catch those big moves regardless of your time frame. So you have to have the ability to sit still and not get flustered by the up moves or the down moves. You have to learn how to hold them as well as, of course, how to fold them. Well, let's toss it open to questions. We've got about 5 minutes left here, I think, maybe only 5 minutes left. So let's see if there's any general questions on what I've gone over. I'll try to answer your questions, and then on the break, we've got another speaker coming right up here, so I'll move in the back of the room or whatever. Yes, please. Please.
Is there a way to get the daily commercial versus
The commercial data is released every 2 weeks by the government. You don't need to get it daily. These guys are real early. They don't try to buy highs and lows. They're real early. So you want it late. Probably should be a couple of weeks later than it is. It'd be better. Question?
For all your years, if you say any system you use, is there a certain percentage of good trades you think you should get out of it? 40%, 50%, 60%? So if you have a system and you're only getting 30%, is that the time you want to use?
It's a misnomer to look at the percentage of accuracy. There are a lot of systems that make money that are 30% accurate. And there's a lot of systems that are 90% accurate that'll lose money. Because it's largest loss, average winning trade, a bunch of other things other than accuracy alone doesn't mean much. But be really careful of just that figure. Anything over here? Questions? Well, I'd like to personally thank Ron Michelson and Futures Magazine for having me here. I've always enjoyed coming to these. I hope you people have learned a little bit today, not only from what I've been able to talk to you about, but the other experiences, the other people that are here. And I'd like to wish each and every one of you nothing but good luck and good trading for the coming year. Thank you very much.